Hello, I'm Peter Herbert, and welcome to this month's short CPD webinar, Top Tips for Auditing Revenue. Over the last 6 to 9 months, we've done a number of sessions looking at practical aspects of auditing. We thought about systems and controls work, we thought about materiality calculations, we've done a session on the auditing of creditors, and this month we're going to focus on auditing revenue, and some practical tips focusing on the planning of the work in this area and its execution. Okay, so our top tip 1, looking at the planning aspect, is to think carefully about the presumption of fraud. And before we get into the detail on that, let's remind ourselves of the requirement within ISO UK 240 fraud. And here's what it says. So when identifying and assessing the risks of material misstatement due to fraud, the auditor shall, based on a presumption that there are risks of fraud in revenue recognition, evaluate which types of revenue transactions or assertions give rise to such risks. And I guess off the back of that, plan and perform testing in response to those identified risks. Okay, it's a common area of discussion. It's not particularly new. There are 3 things that we're always keen to emphasize in this area, and we've summarized those on the next slide. So remember that the presumption is rebuttable. If you are going to rebut it, though, as the slide indicates, it can't just be a yes or no. You do need to carefully document the rationale for rebutting it. Our experience is that firms rebut it fairly rarely, perhaps not as often as they might. We would always be keen to encourage you to think about that on a revenue stream by revenue stream basis. There could be a high risk of fraud in revenue recognition for some revenue streams and not others. Do be careful as well using the existence of good systems and controls to rebut the presumption. You are thinking about fraud risk before you think about any controls that might be used by the organization to mitigate it. So what's the inherent risk of fraud? Sometimes it might be a thing that's very easily provable, very easily auditable. I always think about fairly simple investment property companies where perhaps there's a very limited number of revenue streams, rental income streams that are very easy to prove. It could be at a charity or an academy trust, where perhaps there are certain grants that are very easily provable from an audit testing point of view. But the reality is that firms do rebut that presumption rarely. You do have the right, but do document that rationale really clearly on the audit file. Remember, it's fraud, not error. So what is the incentive or opportunity for a fraud to be perpetrated to give rise to revenue to be materially misstated? How could that fraud be perpetrated? And do think carefully about the relevant audit assertion. You know, is it occurrence? Is it completeness? Is it cut off? And as I've already alluded to, does that particular risk of fraud apply to certain revenue streams, but not others? Careful investment of time in thinking through how that risk manifests itself does then give you payback later on when it comes to planning and performing the actual audit testing. And absolutely make sure that when you are then devising those tests, you are very much focusing on the specific revenue streams and specific assertions that risk does indeed relate to. Okay, so that's just a few thoughts on that. Now, we do see lots of audit files, we do see lots of planning sections, we do see lots of risk schedules, and I think in the context of the whole area of fraud in revenue recognition, this, I suppose, is something typical of what we tend to see day to day. Just in terms of a couple of points of finessing here, possibly, this is largely okay, I think, but I suppose just in terms of the left-hand side, ISO 240, irrebuttable presumption that sales is always high risk unless you can prove it's not. Well, I think if I'm going to be a bit pedantic there, as I've already alluded to, that presumption is absolutely rebuttable. And we can't prove there's no risk of fraud in revenue recognition. We've got to assess that risk. With all these things, you can never be 100% sure. So I think the wording on the left there possibly requires a little bit of thought in that particular context. As I've already alluded to, what assertion or assertions are particularly pertinent in terms of that fraud risk. I don't think it would necessarily be completeness, accuracy, and occurrence. Let's be a bit more selective there. And then away to the right, I think if firms are being very thoughtful about exactly what tests they're going to do to mitigate those risks, that's going to put you on a good track, rather than quite simply saying, we're going to test sales. So not by any means a car crash of a planning form, that one, but it does, I suppose, reveal some of the issues that we sort of flag when we're doing our reviews, just around finessing the way that that whole forward in revenue recognition aspect is addressed on a file. Okay, let's then move on to our second tip, which again applies to this planning stage of the audit. And this, I guess, is a more general one, but it has absolutely got relevance in relation to sales. Perform adequate work on systems and controls in that sales area. I think for lots of firms that perhaps are doing smaller SME audits, because they're perhaps taking a much more substantive approach to the testing, and they're going to in no way, shape or form of the test and place reliance on internal controls, sometimes this whole area can be a little bit light in terms of the level of detail. But it is important to remember that for all the relevant transaction cycles, there's always going to be a minimum of work to be done. And sales, I guess, is really no exception. Just let's think about some practical considerations, though, specifically as they apply to sales. So first of all, if you are doing, and when you are doing that systems work, think about starting at the beginning. I think it's very much important to ensure that you're being very clear in the way that you document systems, where the transaction starts, where the transaction ends. And I suppose when you're documenting that on the planning section of the file, making sure that you're doing that very much in order. When you're doing your transaction testing on sales to a degree, that transaction testing is going to focus on completeness. If we, from a file review point of view, have had a look at those systems notes, and we can be really clear where that sales transaction cycle starts and where it ends, we can then be really clear in our mind about whether we feel you've tackled the transaction test in the right way, and to the extent that that transaction test for completeness, whether your test has started outside the accounting system. So it gives you a good payback in terms of making sure that you're complying with the ISAs. It also means that we can then, when we're doing our review of the sales testing, be comfortable and confident that you've done all that you need to do in that regard as well. Do think about the various revenue streams. Revenue streams are different, and documenting these systems revenue stream by revenue stream will be absolutely something that will be key. In the same way, I suppose, the testing revenue stream by revenue stream will be as well. Remember that it's all about getting evidence of implementation of the important controls. And a point we've made lots over the years is in your keenness to articulate how the system works end to end. Don't be afraid to think about the important internal controls the client has got in place, the checks and balances to ensure that actually things are being done in the way they ought to. Evidence of implementation of controls, does sometimes go awry. And in relation to that work around evidence of implementation of controls, do remember that you cannot rely on inquiry alone to evidence that implementation. So yeah, something like a walkthrough to evidence the implementation of the controls is really key. We're always very keen to encourage firms to do that evidence of implementation piece every year. That will be an important consideration for us. And I think in terms of efficiency of effort, we're always very keen to encourage firms to think about the controls that are actually really important to get a handle on and to evidence implementation of. And for many audits, that won't be lots of internal controls. ISO 315 paragraph 26, that lays down the categories of controls that you've got to get a handle on, that you've got to get evidence of implementation of. And very importantly, that will be including controls in respect of significant misstatement risks. So where you've not rebutted the presumption of fraud in revenue recognition, and for you, therefore, a particular aspect of revenue is a significant misstatement risk, where there's a relevant internal control, you've got to ensure that you've got evidence of its implementation. So very important tie in there to paragraph 26 of ISO 315 as well. Okay, so that's kind of our planning bit. Then in terms of the actual testing, think about the evidence pie. Now, I think about the evidence pie as being a number of different types of evidence that you're going to draw together to inform your conclusion in a particular area. Now, I think for many firms historically, substantive tests of detail have probably been the go-to place for audit evidence. Remember that there are different ways you can gather evidence. Test of control is one, analytical review is another one, audit data analytics is another one. So I think for many firms where you're perhaps thinking about a range of different categories of evidence being brought to bear, substantive test of detail probably is the final part of the puzzle. Now, why I think firms these days are probably being a bit more thoughtful in relation to a number of categories of evidence informing and supporting their opinion in an area like revenue, as we're going to come on to shortly, is that I think sample size caps are probably a little bit less in vogue than they were. And some audit methodologies, as we talked about lots of courses in the last 3 or 4 years, are very much moving away from using sample size caps. If you are therefore completely hanging your hat on substantive tests of detail, and you've got a sampling methodology that is not based on a cap, you can be looking down the barrel of a gun at a really big sample size for that test of detail. So I think therefore being a bit more selective in terms of how you're gathering the evidence is very much sort of, as far as we're concerned, front and central. A couple of points to make about the other elements of the pie there. Tests of control. Even the larger firms that we work with don't use tests of control on a big scale, but it's something definitely we're getting more questions on and we're seeing more use made of in practice. Tests of control can be very effective in areas of significant misstatement risk, where your substantive test of detail sample size could be very large. So think about, embracing tests of control and think about the areas that you're going to do that. And for sure, the significant misstatement risk areas, that could be an area where you do get payback. And ADA, audit data analytics, again, probably used by the larger firms that we do reviews for. I would say that the most commonly used tool, without doubt, there are other tools obviously available, tends to be Inflow. And the ADA tool with Inflow that really helps to support your opinion, certainly on occurrence of revenue, is the revenue analyzer tool. Remember that if you are using those sort of tools within a methodology like Inflow, it's going to work really, really well to help you on your audit testing on occurrence. It's not going to be so effective to help inform your opinion on something like completeness. So whichever tool you're using, be very thoughtful about the actual audit assertion that tool does indeed support. Plan sample sizes carefully. As I said, if you are thinking and focusing a lot on the sort of sample size for a substantive test of detail, this is going to be a very key consideration for you as a firm. Let me just, if I could, perhaps flag up the most common questions we get in this area. And here's the one which comes up all the time. Are sample size caps still allowed? They absolutely are. Let's be really clear about it. There are two very commonly used methodologies in the UK. The Kroner-I methodology, which is now no longer cap-based, and the Immersia methodology, which has a cap-based aspect, probably for the simpler SME audits, and a non-cap-based approach for the larger audits like the listed company audits, the public interest entity audits. Where your methodology allows the use of caps, you absolutely can still use them. I suppose their days are perhaps to a degree numbered, and that's really all around the conversation about, well, if you're going to cap the sample size, when you're sampling and using a cap, can you really then draw inferences about the entire population by just looking at a sample? Is it a fundamentally flawed approach where the cap exists? There's definitely some very good statistical theory that underpins why caps do still work, can still work. And as far as I'm concerned, if that forms part of your methodology, as long as you've made the case, I'm really happy with that. So that, I think, probably is the number one question we get on that area of sample size caps. Yes, if you're using a capless system, then it might be that your sample size calculator comes up with a really, really big number. And I guess in those situations, you've got to be very thoughtful, going back to our previous top tip, about other ways that you can gather evidence so that you're not placing total reliance on that substantive test of detail, where you could otherwise end up with a very, very big sample size. That would be a very inefficient way, I suppose, ultimately, of tackling the audit. And then the other one, can the entire sales population be stratified and the sample apportioned accordingly? Firms do that. I think you've got to be a bit careful, though, there, in the sense that where you've got different revenue streams that have got different features, that have perhaps got different risk profiles, developing a sample size across that entire population and then allocating sort of samples to individual strata of that broader population based probably on their materiality, I think probably is flawed. Again, going back to the way that sampling works, you can only draw inferences about an entire population by looking at a sample where that population is homogeneous. And I think our view is very much to encourage firms to slice and dice the population into its different categories and test each individual aspect, each individual strata of the overall population separately, rather than doing one sample size for the entire thing and then allocating it. You might end up with a similar answer overall, but I think conceptually that probably is a slightly flawed approach, because as I say, you've got to make sure that when you are sampling, you're looking at a sampling approach for a homogeneous population, and for sales figures within accounts where there are a number of different revenue streams. You know, there's individual segments. They're not all going to be one single homogeneous population. And I think therefore slicing and dicing, if I can use that term, probably is very much going to be the way to go. Okay, so a few thoughts there on sampling. And then just finally, you know, listen to the voices. There's some really good stuff that comes out of the professional bodies, the Financial Reporting Council, the ACCA, the ICAW, and the Institute's latest monitoring reports. You know, one soundbite that I particularly picked up on, it was never supportable to say that my sample is calculated as 234, but my methodology says I only need to pick 50 without further explanation. This could very much apply to the audit of revenue, where again, if you are looking at a situation whereby you've got a capitalist sampling methodology, and the figure comes out at a really, really big number, but you're taking the view that that's just really, you know, not viable, and therefore you're going to pick 50 instead. I absolutely am of the view that sample sizes and sample size calculation is an area of professional judgment in the way that you're doing audits. You can absolutely look to deviate from what the calculator gives you and plug in a different figure instead. You've just got to make the case, really, I think, for that deviation. And it could well be that perhaps in a particular situation, I don't know, other evidence is being brought to bear which supports your opinion, which therefore suggests that actually, you know, a much lower figure is much more appropriate than the very high figure that the methodology is giving you. I would challenge, I suppose, a bit on that in terms of maybe in terms of using the calculator and determining the sample size. You know, have you actually really thought carefully enough about the risk profile of the various revenue streams? Have you perhaps thought carefully about the materiality calculation, which again, to a degree, informs the sample size, which is kind of spat out of the system? Have you thought carefully about the way that you bring other evidence to bear? And has that all been incorporated within your sample size calculator in the appropriate way? The move away from caps, without doubt, is broadly speaking, I think, pushing sample size levels up. But 234 is a really big number. You know, you can make a case for a lower number, but that case has got to be made, as the Institute Monitoring Report says there, that where you're moving away from that calculated figure without further explanation, they would have issue, we would have issue, if we were indeed looking at an audit file. Okay, hope that was useful. Do get in touch if you've got any questions about anything I've said in that short session. Inquiries at insight-training.co.uk. And do check out our website for our full autumn programme of CPD events, www.insight-training.co.uk. Hope that was useful, and I'll speak to you all again soon. Thank you.